Michael Burry's third largest position is actually a very complicated spin-off in Warner Brothers Discovery. And that's an opportunity where I actually sifted through all of the documentation and provide you with a really clear view of the opportunity, including a valuation model, which is what I'm going to cover in this video. So guys, smash that like button, subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel, where the goal here is to help at least 1,000 people achieve financial independence much sooner. And I love looking at Michael Burry's portfolio because sometimes he'll enter into some pretty obvious opportunities like Alphabet or Meta, but other times he enters into pretty complicated opportunities, which is a real challenge, which is what I love, because value investing is kind of like a puzzle. And so sometimes these opportunities, you kind of have to sift through a lot of information to really understand. Spin-offs are like that. And so Michael Burry's third largest position is Warner Brothers Discovery, and this is actually one of those types of complicated opportunities. And so in March 11th, you can see that Discovery shareholders actually approved the Warner Media acquisition. And so technically it's an acquisition, but really it's just AT&T spinning off assets into Warner Media, and then Warner Media being sort of like the accounting acquirer. And I'm going to show you that in the next couple of slides. And here I have highlighted Michael Burry's portfolio as of Q1 of 2022. So this will get updated very soon. But you can see that his third largest position is Warner Brothers Discovery, where there's around $19 million invested in this opportunity. Now, the one thing that I do want you guys to pay attention to is that reported price. He paid approximately $25 for this security. Now, if you guys look at the share price right now, the company's trading at around $15. So can we buy into this opportunity at a price lower than what Michael Burry paid for it? And what percentage of the intrinsic value is that $25, or does that $25 represent? And what percentage of the intrinsic value does $15 represent? So who's getting a better deal, or does it even matter if the discount is large enough? Well, we're going to dive into that. And the answer, I think, in my opinion, is going to surprise the heck out of you. And just before we dive into that, I just want to point out that one of the most well-known and successful media cable company investors led sort of this spin-off transaction. And on Seeking Alpha, this is what one of the writers wrote. They said that Malone is a brilliant financial engineer with a vision for future and a Buffett-like ability to allocate capital. I personally don't know if I'd go that far in describing John Malone, but the one thing that I would say is that he and I are one and the same, because we're both psychotic about RVs, and the only types of vacations I want to take are RV vacations, and he does the same thing. So that's my spirit animal right there. But you can see here, this is the large library that Warner Brothers owns. You know, you can see that they own the Game of Thrones franchise, they own Succession, Sex and the City, Matrix. Those are all probably older brands, but they have brands that are continuously generating ad spend. Some of those would be the US Open, the PGA, the NBA, MLB. I guess it's all rights to broadcast these. The Food Network, Home and Garden Television, TLC, TNT, and maybe to a lesser extent CNN. I don't know how much advertising revenue CNN has been generating lately, but it's probably up there still. But you can see that with their, at least their TV portfolio, it's a diversified media offering, because you have access to TV, but they also have access to streaming and selling out the rights to their content library. So there's a lot there with this library. Now, you are going to see many terms being used when you sort of analyze this opportunity, but as of February, they're describing this transaction as a spin-off rather than an exchange offer. And that's kind of how I've been looking at it from the beginning. And so it's nice that they're using that term. But I'm going to sort of dive into that a little bit more with this, and you can see that high level AT&T is moving their Warner Media assets to the Discovery company. But the assets are so large relative to Discovery's assets that they actually created a new company. And so you can see that 71% of this new company is going to be owned by AT&T shareholders. And I actually think that this will cause huge selling pressure, because AT&T investors are likely to be dividend investors and not interested in the new company. And so effectively, you can see on the bottom left here that AT&T is essentially offloading Warner Media and its related debt to Discovery. So that's essentially what's happening here. And so note that it's the shareholders of AT&T that are going to receive the common stock, not AT&T themselves. And that's an important differentiator, because what it allows AT&T to do is offload these assets from their balance sheet as well as the debt. And so that's the goal of this transaction. AT&T does not want to have this debt on their balance sheet, which makes a lot of sense, because it could help them command a higher valuation. And remember what I said, 71% of the shareholders of this new company will be AT&T shareholders. Now, not all shareholders are the same. Some people invest for dividends, other people invest for capital gains. And so I would argue that a lot of AT&T shareholders are sort of dividend focused, and so they're not going to want to own this company. They're going to want to sell it into the market as soon as they get access to the securities. And that's really what we've been seeing. You can see that there has been immense selling pressure from AT&T shareholders who are offloading these shares, and has brought down the share price down 40% or over 40%. And what this is a textbook and predictable sort of situation or occurrence that you could have sort of predicted. And in fact, it was actually written about in a very famous book. So there's a book called You Can Be a Stock Market Genius, written by Joel Greenblatt. And in the book, he talks about different types of opportunities. Mind you, this is not a paid advertisement or anything, but I'm just saying that there was a chapter in the book talking about spin-offs. And what he says is, if you give shares to people who don't necessarily want to own them, it creates a really good opportunity for value investors, because those people who don't want the shares, they'll sell them off, and it could create a very good buying opportunity for people that are looking to pick up a very valuable business on the cheap. And so that's kind of what's happening here. And so we could have predicted the share price to decline. And in fact, that's what I did, because Michael Burry didn't just buy into his discovery position recently. He's had it for a couple of quarters now. And so the one thing that I was waiting for is the share price to decline. Now, it's been 3 months since those shares have sort of been released to the public, and we're noticing that the share price has declined over 40%, but you're noticing that it's leveling out a little bit now. And so there could be an opportunity to purchase these securities on the cheap now. Point that I do want to note is that Michael Burry actually made his position at $25 a share, and note that they're trading at $15 per share. Now, he's a lot smarter than I am, but I personally in this situation would have waited a little bit, and I have been waiting, but it's looking more like I'm going to initiate a position in this opportunity very soon, and I'm going to show you how I'm going to invest in this opportunity closer to the end of this video, so stay tuned. Now, over here, you can see that this sort of just explains the transaction a little bit more. The two areas that I want you to focus on is the first one, where I say Warner Media Business was distributed to AT&T shareholders via pro rata distribution, and immediately thereafter they combined with Disney. So effectively, I'm saying that dividend investors don't want this, which could lead to selling pressure, which leads to an opportunity. And I just put a question mark there. Now, the other thing that I want you to focus on is that last line. Accordingly, the financial statements of WBD as of and for any periods prior to April 8th, 2022, do not include the financial results of Warner Media's business, and future results will not be comparable to historical results. Why does this matter? Well, it matters because right now, the market cap of the company reflects the new company, but the financial statements reflect the old company. So there's a bit of a disconnect. And this is why I always say, you gotta follow the story, not just following what sort of like the information gathering websites spit out to you. Your metrics will be all wrong. And here's the note from the latest quarterly report. Due to the limited time between the transaction date and the company's filing its quarterly report and 10Q for the quarter ended March 31st, 2022, the business combination is incomplete, and the company is not yet able to disclose the provisional amounts to be recognized as of the acquisition date for assets acquired and liabilities assumed. So we do not have a good picture of what the balance sheet looks like, but I have something for you. So I actually sifted through hundreds of pages of disclosure that was announced for this transaction, that was listed with the SEC, and I have a pro forma balance sheet to show you guys. So you can see here that the pro forma combined balance sheet is expecting to have, or did have as of December 31st, $10 billion of cash and $155 billion of total assets. Note that the combined company has $155 billion of assets and $100 billion of liabilities. So effectively net $55 billion of assets, but it's trading for $35.5 billion. Now, why is that? Well, notice that some of their assets are sort of intangible in nature. Now, the film and television library probably could sell for around $30 billion. So it's probably accurately reported on the financial statements, but it's hard to tell what those intangible assets would sell for. You got to sort of dive into them and understand what they are. And that goodwill, that's just a balancing adjustment. So really what goodwill is when you pay money for a company, And what they'll do is they'll fair value all the assets, and any cash or price that you paid for the business that's left over after that calculation goes into goodwill. So it's an accounting balancing equation. And the way that accountants support that goodwill number is they do what's called a goodwill test at the end of every year. Effectively, what they're saying is you value the company based on a certain cash flow profile for the business. Does the business still have that cash flow profile? If it does, then what you paid for the business still makes sense, and so goodwill stays the same on the balance sheet. It never goes up, but it could go down, which is referred to as an impairment to goodwill, where effectively the future expected cash flows for the business are lower than what you sort of expected when you initially made the transaction. So you might, in this environment, see quite a few goodwill impairments happen for companies that were buying other companies at elevated prices in 2021. So just keep on the lookout for that. And so from here, you can see that the current portion and the non-current portion of debt equals approximately $57 billion. So there's a ton of debt with this company, and they're gonna have to pay it down. And here's their consolidated income statement. So you can see that on the back of the envelope suggests that the combined entity generated around $6 billion of free cash flow in 2021. And when you compare that to the current market cap of approximately $35 billion, you have maybe what's considered a 17% free cash flow yield, and of which a significant amount of that cash will be needed to pay down that $56 billion of debt. So they have a long way to go to pay down that debt. So in the valuation for this company, we do have to penalize them for that debt. Now, I penalize every company for the debt, but this one we especially have to really consider doing. And now I got my hands on something really cool. They actually forecasted to 2023 what they expect the unlevered free cash flow for the business would be. And you can see that right here where they're forecasting the Discovery business and the Warner Media business. And so when you combine those two, notice first of all that I was wrong for their 2021. I said that the free cash flow would be around 6 billion. They're saying that it's probably going to be around 5, that 2.6 plus the 2.4. But in 2022, notice that the combined entity is expected to have $6.1 billion in unlevered free cash flow and $7.1 billion in unlevered free cash flow in 2023. So according to management, it reflects a 2022 free cash flow yield of 17.2% and a 2023 free cash flow yield of approximately 20%. So that's huge based on the current valuation. So it's very clear that this company is undervalued. The only question is how much of the debt comes off from that valuation, and does the net valuation still represent an opportunity relative to the current share price? And I'm going to show you all of that. And the way that I'm going to do that is I actually created a model for Warner Brothers Discovery. And you can get access to this at the lower tier of the Patreon. But the one thing that I want to point out to you is that I'm a little bit suspect of management's numbers, and here's why. Notice that their free cash flow as a percentage of revenue in 2022 was around 10%. In 2023, they're forecasting it to be around 12%. But in 2030, they're forecasting it to be around 15%. So I understand that they're going to get some synergies here, but are they going to really get 300 basis points of synergies to make the business 50% more profitable than what it was in 2022? That's a hard forecast to grasp. And so I would be a little bit suspicious of that. But like I always say, I always like to value the companies out the way the managements are forecasting, unless there's sort of like an obvious area where you can bring down the numbers. But then I like to do a 50% haircut to my valuation, and then I'll only buy at that 50% level. And so you can see from here that using a 10 times terminal multiple, because I don't think that the company is going to grow as fast as what management thinks is going to grow beyond 2030. So I'm just using a lower multiple. I'm using a higher terminal discount rate of 11.5%. In fact, I use that terminal discount rate for most of the opportunities that I value. I'm valuing the company at around $47 per share. Compare that to the $15 per share, and you have a real value. However, notice how much debt they have. Their debt actually brings the valuation down by $19.50. And so the net valuation is $28 or $27.75. And now you subtract that from the current share price. And so the share price as a percentage of its intrinsic value is around half, so 52%. Remember that I said that Michael Burry bought this for $25 per share. So I don't know how he was valuing the company, but I can't see, based on the information that has been provided, that this company was worth significantly more than $25 per share. And the current share price of $14.65 reflects a free cash flow per share yield of 13.5%. So that's pretty exceptional. But note that the true annual free cash flow yield is probably higher than what I've calculated, because management is not going to pay down 100% of the debt. So that's probably what upside Michael Burry was valuing into his valuation. But I personally penalize everyone's valuation for the debt equally, and that's what I call the more money way. And this is what I mean about management paying down the debt rapidly. They have a rapid deleveraging target. So there's two ways that you can sort of think about debt. The one way is it's never going to get paid down, and even if it does get paid down, it gets paid down 10 years from now. So you should discount that value of the debt by at least 10 years. So that's one way to sort of think about it, but you can't really do that in this situation because management has told you that they're aggressively deleveraging. And so the only way that they're going to aggressively deleverage is by using the free cash flow that you generate in those early years. And so you do have to sort of reduce that valuation by the debt that's on the balance sheet. Now, you don't have to do all of it. You can sort of take 40% of it, which is what they're looking to deleverage the debt by, and then sort of discount out the remaining 60%. But I'm just going to do 100% because I'm conservative. And so the question is, because the intrinsic value is just a little bit over 50% greater than what the current share price is, you might not feel comfortable because there's a lot of questions to still be answered. Like, are the results coming down? How is competition going to be impacting this company, et cetera, et cetera? And your answer is as good as mine. And so you might want to buy this at a price lower than $15 per share, and I wouldn't blame you. And so one of the ways to sort of look at this is with cash secured puts. I love utilizing cash secured puts, and so you can see from the cash secured puts that if you're like me and don't want to buy it at that $15 per share range and rather get a larger margin of safety, take a look at the 6-month cash secured puts, the January 2023 $12.50 per share cash secured puts. They have an annualized yield of 21% or a 10.4% simple yield. And so that's at $12.50, where you can probably sell it for $1.30. The net purchase price would be approximately $11.20 per share. And compare that with the current share price of $15 per share. So it's a huge discount to what it's currently trading at. And that reflects a free cash flow multiple of 5.6 times free cash flow and reflects a yield of 17.7%. And so all of this information is actually modeled out in the tracker. And of course, the model for WBS is in its own sort of tab, which is linked to the tracker. So you can get access to all of that. And so the question is, how do you get access to it? Well, you can access all the models at the lower tier of the Patreon. And if you are interested, I put on a live presentation each month where I reserve my absolutely best work for, and you can get access to that call at the upper tier of the Patreons and join us on a live Zoom call every month where you actually do get an opportunity to ask me questions live one-on-one. And as usual, like I always say, if you do try out the Patreon and you decide that it's not for you, no problem. Let me know before you unsubscribe so I can fully refund the money that you used to pay for that first month, because I don't want you to pay $1 if you don't get any value out of it. And up until now, nobody's taken me up on that offer, which makes me feel really good because it tells me that what I'm providing is of an immense value. Now, the other thing that I want you to be aware of, this isn't Michael Burry's only big investment opportunity. I actually covered another one, which you can get to right here.